morning. Welcome to Wednesday, the Brew. I am your host, Lex. Today, we're going to talk about my favorite zero DTE strategy. I know the title might have said bonds and what have you, but we changed our mind. So we'll talk about bonds in another episode. Secondly, before we get started, we were supposed to have Jonathan on today from Cboe, but he had an unexpected conflict. So we will see Jonathan next week on Wednesday, 9 a.m. Central, live to talk about some cool things around volumes that Cboe's seeing. Anyway, let's get started with the brew. My co-host Barbie is coming in soon. Oh, hi, it's me again with no Molly. Oh,
wait, I needed an entry, my Barbie entry with a hair flip, but I can't even do a hair flip.
I was going to say, am I right about
Thanks,
the Barbie?
boys.
Am I right about the Barbie? It's
you are.
You got the blonde
what
hair.
Am I doing today? What am I doing?
You got the pink thing going right now. I like it though. It's other than white or and black that you normally wear, so that's cool.
I did just wake up, so I am having a hair moment.
Yeah, that's
bear
good.
with me.
That's all right. That's all right. So, Mal, guess what we're talking about today? You're going to ask me questions.
Yes. So, what is a zero DTE?
So, we're talking about zero DTE today. Great. Oh, by the way, this hat is not a joke.
First I want to know about that tag. Are tags in?
The University of Wyoming or Wyoming University, the Cowboys, a friend of mine's son plays football there, got me the hat, except would you rather have this hat full of quarters or $1 million? I think you want the quarters. This is the biggest hat.
I don't know. I'd like to fill those with zero DTEs.
All right.
Can we do that this morning?
We can. So let's get busy. So zero DTEs, again, we talk about this a lot. It's the talk of the town right now. It accounts for, I think, 50% of the SPX volume at Cboe. So
whoa! Wait. That's a big deal.
That's a big deal. So that's a lot of trading. And
there's been a huge growth over the last couple of years. Is that correct?
It's massive. I would say
it's exploding.
It's exploded, right? So people love this. And as a result, retail traders love trading this because instant gratification. It's going to expire today. So first of all, let's make sure we understand zero DTEs, what it means. It means that let me take one step back. Sorry. We've had zero DTEs in the past. It was one Friday of the month, which was the regular serial expiration. It was the third Friday of every month. When that day occurred, that's a zero DTE, essentially. What Cboe did with SPX along the way is they added 2 more expirations each week. They added a Wednesday and a Monday expiration. So now a zero DTE could occur on a Monday, a Wednesday, and a Friday when it was the day of expiration, right? Cool.
Wow, that's going.
Good. So what they did recently is they added Tuesday, Thursday. So now if you think about it, there's an expiration on Monday through Friday every week of the year. So next week's zero DTEs are already listed. They're listed Monday, Tuesday. They're not zero DTEs yet because they are not expiration day. Okay? Just make sure we understand that. So you have an expiration every day in SPX, and I think their symbol is SPXW for the zero DTE. So all of those daily expirations are SPXW, whereas the old SPX is the third Friday, the serial expiration. Someone correct me if I'm wrong. I think that's right. Okay. Anyhow, the love of these things is that, as I said earlier, everyone loves instant gratification, right? So with these things expiring every day, you can come in, and I do this now. So you can come in, you can place a trade in a zero DTE. By the end of the day, it expires. The beauty of SPX is that SPX is a cash settled index. What does that mean? That means that when it expires into cash. You do not get stock or an underlying asset. You just get the value of the index less your strike price. Okay. If it's out of the money, it obviously expires worthless. If it's in the money for a put, you get the difference. If it's in the money for a call, you get the difference. It's cash. So why is that important? Because you don't have to finance stock if you get assigned, which is expensive for retail folks or people with smaller accounts. So that's why it's beautiful for folks to be trading this who have smaller accounts. Now, granted, it's a $4,500 entity. We'll talk about some other choices.
Would a good
Go ahead.
would a good analogy be that if it's cash settled, it's sort of like there's a poker table, but you're sitting in the chairs around the poker table watching the guys who actually are holding those stocks. So you can play in the game, but not heavily invested. In which case, a retailer trying to get in and maybe not a large amount of capital, this might be a good entry.
Yeah, this is an easy entry for retailers, I think. You know, the only downside of SPX, I think, is there's a couple. One of them is the size of the index. Okay, hold on. That's a doggy barking in the live show. Now what am I gonna do?
We'll cut. Okay.
I'm gonna get up and let her out so that she can go see mommy.
That's the cool thing about live shows, because you can't cut. This is the real BTS
This is the real
of Lex.
I'm getting there.
Maybe she's interested.
Yeah, I'm back.
Maybe Boo's interested.
I'm back. Okay, so what was I saying? Zero DT. Yeah. What'd you ask, Molly? I apologize. I'm thinking about a dumb dog.
Lowering the barrier of entry and then you were saying that SPX has some downsides. Instant gratification, I'm sure there's some downsides.
Yeah. Well, you know, what am I looking at here? This is weird. Oh, I know what I'm doing. I'm looking at my trade I just made. Yeah. So the downside is the size of the index. It's $4,500. So you know the option prices are going to be bigger. You're going to need more money to margin bigger positions, right? So typically, you know, what I see in the retail side generally is people are trading 1s and 2 lots in SPX. Okay, that's okay. You know, there's plenty of money to be made there doing these sort of things. Okay. The other, what's the other downside? There's not another downside, I don't think. So the other thing about SPX, it's European exercise. Okay, or it's a European exercise contract. That means that it cannot be assigned or exercised before expiration. The only time assignment or exercise occurs is on expiration day. Now with zero DTs, that's, you know, every day of the week in that particular contract. Okay, does that all
which
make
is
sense?
Nice. Yeah, which is nice because there's no bogeys. You know, you can just go away and rest easily. That
yep.
nothing weird's going to happen.
It's a retail trader's dream, quite frankly.
Yeah.
And that's why a lot of these folks have flocked to this. It's very liquid too. So it's one of the, you know, top option traded volumes out there. So the other thing is there's a mini SPX called the XSP, which Cboe just listed, you know, fairly recently. It is 1/10 of SPX, same components. Okay, so I tend to trade the XSP. The drawback there is it is not nearly so liquid as SPX yet. So you will have wider markets, you will have less volume in XSP, but it is 1/10 the size of SPX. So if SPX is trading 45.70, okay, XSP is going to be trading 457 and change, right?
Okay.
So, and you could do, you know, if you do 1 in SPX, you do 10 in XSP. Make sense?
Okay. Yeah.
You can also trade small. You can trade 1 and 2 lots in XSP as well. It's just not the same bang for bang if you're not, you know, if you're not on that ratio.
So there's word on the street that zero DTEs are risky. Why is that?
You know, some of the things that I've heard around zero DTs in terms of risk is that market makers who take the other side of all these trades will have resulting inventory that could cause a Volmageddon, right? You know, Jonathan next week when he's on from Cboe, he will refute that. I believe, as Jonathan does, that that's probably not a likelihood. Market makers are very adept at managing risk. Okay, and from what I've heard and talked to some of my market maker buddies who are still in the industry, most of these big institutional market making firms, they probably have a whole team dedicated to zero DTE, and it's probably carved out of a market maker's total inventory. So the team trades zero DTE, the rest of the firm is trading the rest of the book. It could be, you know, even further SPX expiries. So I think they segregate that out. They're pretty well hedged, and there's some cool tools out there that show market maker positioning in zero DTEs and, among other things, right? So I don't think that's a risk at all. I really don't. I'd be surprised. I think longer dated stuff could be a risk, but I don't think that is. But anyway, go ahead. Sorry.
And next week we're going to reveal a couple articles that Cboe published internally to explain some of that. So the big reveals next Wednesday. It's going to be a good show.
Yep.
So let me ask you this. So because it's every day, there's limited time to make decisions for a retailer. What's some advice you could give someone to? Yeah. What is a day in the life of a zero DTE trader look like?
Let me go here for a second. Oh, and I just did something wrong. This is fun. Okay, let me share my screen. So let's do that. Okay. So this is TradeHawk. We know TradeHawk. So what I'm going to do is I'm going to go through my steps of figuring out a zero DTE trade. Okay. So the first thing I do is, you know what, I'm going to do here's what I'm going to do. This is so fun. I'm going to do the remarkable because the remarkable is the remarkable. Do you see that? Okay. Sorry. So here's 4 quick steps, right? First of all, I determine whether implied volatility is high. And we're going to run through these. I don't want to be too long today, so we might have to do this on the next show with John.
Okay.
So let's get the steps first, and maybe we'll look at the trade next time because I want to make sure we're on time. First of all, I determine IV level. That means, is implied volatility high or low? Okay. I don't want to be selling cheap stuff. I don't want to be buying expensive stuff. We as retail traders have to be in the edge game, right? So we need to figure out where our edge lies. If volatility is expensive, sell it. If volatility is cheap, we have to figure out clever ways to buy it. Now, I, as a trader from all my years, was aligned on the premium selling side of the equation. I like to sell premium, collect theta. That's harvesting theta. Oh my God, drink. Because my personality was such that I like to make money every day, just a little bits, right? I was a singles hitter, a punter. I wanted to be on base a lot. I didn't swing for the fences. So I typically did not like buying premium. Buying premium, typically, and there's ways around this, typically causes you to have negative theta. And I say typically because there are ways around it, okay? So when you have negative theta, it's like water torture. Notice I didn't say the nationality of the water torture because everyone would be mad at me, racist or something. So I said water torture. It's you lose a little bit of money every single day, and then one day you hit it big. I can't. I don't like that. I can't take the daily losses, and then here I am. I'd rather have the opposite. So that's why I like to sell premium. Determine IV level, important. Okay, sell expensive things, buy cheap things. Next, compute the expected move. The expected move is embedded in the straddle of each expiration. Okay, so a straddle is an at the money call and put. TradeHawk does a great job of highlighting it in an orange band. You add the midpoint of the call, you add the midpoint of the put together, you come up with a number. Okay, let's say it's 15. I'm making that number up. You take the current strike of at the money, subtract 15, find what that strike is. You take the current at the money, add 15, find out what that strike is. So in premium selling environments, what I'm going to do is I'm going to place my shorts around that expected move, right? And I'm always going to try to get a little more, right? Beyond
is this called standard deviation? Is this called standard deviation?
That's exactly right. So at that expected move, it's one standard deviation roughly. Okay, again, the mathematics isn't exact, and there's a mathematical formula to this, but we're not going to kill ourselves. This is not brain science. It's kind of like hand grenades. Just get close.
I'm in my Barbie outfit, so it's brain science for me. Okay.
All right.
Go easy on us.
So let's say we're selling premium because volatility is high enough. So number 3, selling versus buying premium. We have to make that decision based on our implied volatility assumption, right? So I'm going to pretend like it's high. It's not high now, so we're going to pretend. So I do an iron condor. I place my shorts beyond those standard deviations so that I get a little cushion even so, right? And then I place my longs even beyond that. We'll see one in a second here, okay?
So padding in your shorts.
Padding my shorts. You got to pad the shorts.
Clip that for for
Yeah.
social, padding
You
in
got
Lex's
to pad
shorts.
in you got to pad your shorts. Fourth step, compute reward to risk ratio. Why do I say it that way? I want to know, okay, what my expectation is on dollars earned, okay, essentially. So what I like to do is, what is my reward, which is max profit, divided by what is my risk, which is max loss, okay? These iron condors, these short iron condors, you are not going to get a lot of money for them. So if you can get, in my example, I think I looked at one just earlier before we came on, $90 cents per contract. So that's $90 in options parlance, okay? So I can make $90 and I have a 5-strike separation. And we're going to look at this on Trade Hub. I have a 5-strike separation. So I can lose $5 less my credit, or 90 cents. So my max loss on either side, call or put, is $410. How do I get that? It is 500. I'm going to write in a little corner here. 500 for the $5. So it's $5 times 100 in options minus my 90 is 410. Did I do that math right? Yeah, look at that. It's scribble again. I can't even read it. So I can lose 410. So people are saying, well, what the hell? You can make 90 and lose 410? Screw that. I don't want to do it. That sucks. It's a horrible ratio. But here's the problem. Let's look at Trade Hub real quick. Okay. So the problem is that you need to look at the probability of profit. What are the odds that you make this profit? Now, Trade Hub does this for you automatically. I have put this iron condor. No, I haven't. I did the old iron condor. I'm going to send this to What If. So our What If risk analyzer will give you a number. Now look at this. This is important. It's super important. This middle green part is your profit zone. There is a 98.62% chance that we make a profit. Okay? 98.62. So we have to use that in our equation. And let me see what the number is here. Sorry, I can, Trade Hub does this for you too. Is a different one. So what we would do is we'd multiply that $90 times 0.9862. That's 98.62% in decimal terms, and come up with a numerator. Okay. So think about what we're doing. 98% of the time, 98.5% of the time, we're going to make $90. So you can do that over any time frame, 1,000 days. Okay. 1,000 days, 98.62 of them, you're going to make 90. So you multiply 90 times that number, you come up with a value. Then the other numbers where you lose 1.28 and 0.10, add those together, that's 1.38%, 0.0138 times 410. Okay, in this example. So what I did is I had different numbers before we did this pre-show. I used this chicken scribble down here, so they're a little different. I came up to a number of 82.98 I'm going to make, 31 I'm going to lose. It's a 2.6 factor, risk reward to risk factor. I look for 2.5 to 1 or greater. You'll find some of these spreads that can be 3.5, 4.5, 5.5, which are great. So now all of a sudden that $90 versus 410 looks a lot better because I'm typically in a winner's position at 98% of the time to make this, right? So does that make sense? Or is that just utterly chicken scratch?
No, I was going to ask a question on what fundamentals would cause you to go outside of your risk parameters.
None.
Would extend your discipline.
I would never extend my discipline. I stay disciplined.
Good to know.
That's the other important feature here. And again, I know we're going long. Okay, we're almost done. That's another important distinction. If the trade doesn't make sense, if I don't get 2.5 to 1 or greater, I'm not doing it. Don't be a FOMO. Okay. Do not be a FOMO. If the trade doesn't set up for you, look somewhere else. Do something else. I can't stress this enough. It's one of the I have 4 habits of successful traders, and one of them, or 2 of them, one of them is discipline. Okay. Treat it like a job. It's discipline. And the other one is, don't do a trade. Sometimes the best trade you've ever made is the one you don't. Okay. If it's not there, it doesn't set up, it doesn't meet your risk parameters, your trade plan, bag it. Go to the goddamn Starbucks and get yourself an iced coffee.
Some of the best trades you'll ever make are the ones that you don't enter. I like
Yep.
it.
I can't tell you
Okay.
how that's played well in my life, in my
Okay.
professional life. It's awesome. So anyway, that was a bunch of gibberish. I know. Rewatch this. It'll be online on Options Brew TV, YouTube.
And
Um,
listen,
but it'll be there. Go ahead.
I think that you know, I think that's going to go away soon. That zero DTEs are risky, and I think that with the high frequency, there's a lot of transaction fees involved on the back end for people involved. So they're going to dedicate teams to make sure this goes well, and
Yep.
it'll continue to grow. I wonder what a couple years from now looks like. I mean, if that growth has happened so quickly, so really great questions
Yep.
we'll ask on the show next Wednesday. So come and join us. And
Yeah.
thank you, Lex, as always.
We have more to go, but we're going to stop here. We're going to pick this up with Jonathan next week. There's some great things to talk about relative to zero DT. So that's a good point, Mal. We'll pick it up next week. But NASDAQ just put something out that they're looking at the zero DT and ETFs now. So treasuries and the like, volatility products. So I think you're going to see more of this. But
and I think Larry Fink was in an interview, and he wants to do all ETFs. So
love it.
We're headed there.
Okay, good deal. All right, catch us next week, Wednesday, with Jonathan from Cboe. It'll be a great show. We'll talk more about this and get some real cool stats on volumes. Thanks, Barbie, Lex. It was good to see you. You look great as a Barbie, Mal. All right, wrap it up. Live it up, everyone. Trade well.
Bye, Legs.
Bye.